Welcome to the Explainer. You know, we tend to think of a balance sheet as, well, kind of boring, right? Just a static list of numbers. But what if I told you it's actually more like a crime scene? A place where the real truth about a company is either laid bare or cleverly hidden. So that leads us to the big question.
So can a company's balance sheet actually lie? Oh, you bet it can. Absolutely. Look, while the numbers themselves have to add up, assets have to equal liabilities plus equity, the story they tell, that can be completely misleading. And learning to read between those lines to spot the fiction that's hiding in the facts, that's probably one of the most powerful skills you can have as an investor.
And you know who got this perfectly? The legendary investor Charlie Munger. He said it best. He didn't just see a list of what a company owns and owes. No, he saw something deeper. He saw a psychological profile of the people running the show. It tells you everything about their attitude toward risk, their honesty, and really where they see the company going long term. It helps you figure out, are you partnering with real builders or are you getting into bed with financial magicians?
Okay, so let's do this. Let's put on our detective hats. From now on, we're not just going to read the balance sheet, we're going to treat it like a financial crime scene. A place where we look for clues, we question everything, and we work to uncover the real story hiding underneath.
And right at the heart of the issue is this one little word, discretion. See, accounting rules, they aren't like hard and fast laws of physics. They're more like flexible guidelines, and they're packed with judgments and estimates that management gets to make. Now, that leeway can be used honestly, of course, but it can also be used to puff up assets, hide debt, and basically paint a dangerously rosy picture of things.
So, when a real forensic analyst cracks open an annual report, they're on a mission. They're not just reading, they're hunting. They're trying to detect if earnings have been manipulated. They want to assess the company's true financial position, not just the one on paper. Their whole goal is to predict financial trouble before it blows up, to really evaluate the integrity of the people in charge, and hey, sometimes to uncover some hidden value that everybody else has completely missed.
All right, our investigation officially begins with the very first clue, the assets. This is all the stuff the company claims it owns. Factories, equipment, investments, the whole shebang. But here's the question. Are they really as valuable and productive as the company says they are? Let's dig in and find out.
One of the first tools we're going to pull from our detective kit is something called average asset age. It sounds a little technical, but it's pretty simple. By looking at how much an asset has depreciated versus the yearly depreciation charge, we get a really good sense of how old it is. So why does this matter? Well, think about it. A company trying to compete with old, decaying equipment, it's like a car with 1,000,000 miles on it. It's heading for a cliff, staring down huge replacement costs, and just not being as productive as it should be.
And we can actually put some hard numbers on this to see what's healthy and what's not. If you look at a healthy company, its assets are usually somewhere between, say, 3 to 7 years old. And super important, it's investing enough new cash to replace things as they wear out. But once you see that average age start to creep up past 8 years, and even worse, the company isn't even spending enough to cover its own depreciation, that's when the alarm bells should be screaming in your head. It's a classic sign that management is just squeezing every last penny out of the company for the short term instead of investing in its future.
Now, beyond the physical stuff like factories, we have to really dig into the financial investments. And this is where the story can get really murky. The single biggest red flag to look for? A big chunk of what they call level 3 assets. Okay, so think of it like this. A level 1 asset is simple. It's a stock, it's traded on a public market, we all know the price. But a level 3 asset? That's priced using the company's own secret formula. It's a total black box. And you better believe that's where enormous risks can be hidden.
Okay, so that's one side of the ledger, the assets. Now let's flip it over and look at the other side, uncovering hidden debts. Look, having overvalued assets is a problem for sure, but hidden debt, that can be an absolute killer. And the most dangerous liabilities are always the ones you can't see right away.
Exactly. For literally decades, companies have used all these clever tools like operating leases or special offshore entities to keep massive amounts of debt completely off their official books. Now, the accounting rules have gotten a bit tighter over the years, but a smart analyst knows this. Where there's a will to hide debt, there is almost always a way. And these complex structures, they kind of have two faces. On one hand, you might set up a special entity for a totally legitimate reason, like managing a specific joint project. Makes sense. But on the other hand, it can be nothing more than a shell game, a magic trick designed purely to hide debt from you, the investor. So the detective's job is to figure out what you're looking at.
Is this a real business need, or is it just some clever and dangerous financial engineering?
Okay, enough theory. Let's see how these forensic clues actually play out in the real world. We're going to dive into the spectacular collapse of ILNFS in India. This was a massive financial disaster. But here's the thing. It could have been predicted by anyone who was willing to do just a little bit of this financial detective work.
I mean, look at this. The evidence was hiding in plain sight. In the years leading up to the collapse, the warning signs were just flashing bright red. The company's official debt-to-equity ratio, it more than doubled to a crazy 8.9 times. The debt it had hidden off its balance sheet, that tripled. And its asset quality completely fell off a cliff, with a quarter of its loans going bad. This was not a sudden shock. This was a slow-motion train wreck that was visible for years to anyone who bothered to look.
So what were the obvious can't-miss-it signs? First, you had this super aggressive growth that was being funded by short-term debt to pay for long-term projects. That's a classic recipe for disaster. Then there was this ridiculously complex structure. We're talking over 300 subsidiaries. It was designed to be impossible to understand. And maybe the biggest red flag of all, you had multiple auditors resigning without giving a clear explanation. The clues were all there, just waiting to be found.
So how can you take this detective's mindset and use it yourself? Let's boil everything we've talked about down into a simple but really powerful checklist. Think of it as your own personal forensic detective kit.
Okay, here it is, your 5-step forensic checklist. Number 1, assess the asset quality. Are those assets really as valuable as they seem? Check their age, check their productivity. Number 2, hunt for the hidden liabilities. Look for those off-balance sheet items, the leases, the special entities. 3, analyze working capital. Is inventory just piling up? Are customers not paying their bills? See if cash is getting trapped. 4, scrutinize the capital structure. How much debt do they have? And crucially, when is it due? And number 5, and this is a big one, always examine transactions with company insiders. It's a classic hotspot for funny business.
If you take away just one thing, let it be this. The crucial point, the whole game, is to focus on the economic substance, not the accounting form. You have to look past the official rules and get to the reality of the situation. Where is the cash actually coming from, and where is it really going? What are the true risks this business is taking on? That's what matters. Don't get lost in the paperwork. Always hunt for the substance.
And that leaves us with one final question for you. Now that you have this forensic toolkit, now that you know what to look for, what's hiding in plain sight on the next balance sheet you read?